Welcome to Mortgage on My Mind, where we take the mystery out of mortgages and make dreams of home ownership a reality. I'm Natalie Salins, a top 1% mortgage broker with 20 years of experience, based right here in sunny Los Angeles. If you've ever wondered about pre-approvals, appraisals, or what loan product is right for you, don't worry, I've got Mortgage on My Mind, so you don't have to. Each week, I'll bring you expert advice, real-life stories, and insider tips to help you navigate California's competitive real estate market with confidence. Whether you're buying your first home, refinancing, or just curious about how it all works, this podcast is for you. So let's talk mortgages, demystify the process, and make your real estate goals a reality. Ready to get started? Let's dive in. Welcome to Mortgage on My Mind. We're here today with the wonderful Devin Lucas. He is a top producing real estate broker and attorney, which is what makes this even more interesting today. Based in Newport Beach in California, he has over 20 years of experience and leads Lucas Real Estate under Coldwell Banker Global Luxury. He specializes in high-end residential sales, trust and estate properties, and complex tax-related transactions. He is known for his deep legal and market expertise, serving a wide range of clients throughout Orange County and I'm sure all of California. Welcome, Devin. So nice to have you on.
Thank you so much, Natalie. Thank you for having me. Pleasure to be here.
Yes. So tell us a little bit about your expertise with being a lawyer plus a real estate agent, like how that really does benefit and add value to your clients.
Well, yeah, thank you. So I think it's enormous benefit. I mean, look, California, the reality is, there's a lot of exceptional realtors, especially in our area, but a lot of times, realtors are just focused on being salespeople. And at the end of the day, that's obviously a critical part of being a realtor. You want to get someone a property, you want to be in the know, you want to do things like that. But purchasing a home is usually not only your biggest investment, but it also is probably one of the most complicated legal things people are doing, especially when it comes to sellers. There's so many disclosure requirements, tax considerations, all sorts of things that obviously as an attorney, and then my wife partner as a CPA as well, that we feel like we're able to kind of guide people well above and beyond what you would get from a traditional realtor, to be frank. And there are a lot of states, we have a lot of clients, for example, from the East Coast, Midwest, Massachusetts, Illinois, places where they're used to using attorneys in real estate. In fact,
I was just going to ask that. Yeah.
Yeah, you use an attorney.
Are you licensed there as well?
No. So we don't practice in those areas, but we do get a lot of clients that are transplants from those areas that are just used to, of course, I'm going to get an attorney involved in my real estate transaction because that's just the way it's done in a lot of other states. So we are kind of fortunate that just by virtue of that, we do get some people that seek out that service. And then a lot of people just sort of find out that, oh yeah, we also do that. So it's a great add-on that we can certainly talk to people about taxes. And, a lot of what we do, certainly on the sales side is, unfortunately, a lot of it surrounds death. So there's oftentimes a death in the family. So we're helping the trustee, we're helping them navigate things. We're talking about some of the tax considerations. And like I said, just sometimes these conversations that, you wouldn't get, or sometimes you're not really supposed to be getting with a conversation with a regular realtor. And that's certainly something that we really pride ourselves on, is being able to sort of go above and beyond and give that extra little bit of guidance and strategy that sometimes you're not able to get.
And can you tell, for our audience sake, who mostly are in California and escrow states, can you tell us the difference between the two? Like what entails an escrow state as opposed to a lawyer state when it comes to closing and things like that?
Okay, I know what you're saying. Well, basically, at the end of the day, it's sort of the same concept, right? You've got this third-party middleman or middlewoman or middle company that's going to be the settlement provider. So they're the ones that are going to take the check from the buyer, or obviously the wire transfer from the lender. They're going to take that initial deposit. They're going to hold on to it. They're going to get that notarized deed from the seller and hold on to it. And they're going to kind of keep it nice and safe until the day comes to do the closing. And then they're going to, hand over the money to this person, record the deed with the county, and get that done. So, big picture wise, it's sort of the same thing. It's just a matter of certain states have attorneys that are involved in facilitating that. So you would actually go to like a law firm office and you'd actually sit down at a conference room. People ask in California all the time, they're like, when's the table closing? When do I show up? And we tell people we don't really do that in California, right? You kind of docu-sign something and you're done, and it's a little lackluster. But certainly in a lot of other states, or maybe back in the day before a lot of electronic signatures, you would actually show up at a lawyer's office and you would sit down at a table and you would notarize the documents, and the other side would pass the cashier's check to you across the table. And it was kind of a little more of a formal meeting point and formal sort of middle person that was involved in that transaction.
I'm from New York, and I did that when I bought an apartment there. Yes.
There you go. But now in California, we have escrow and title companies. And funny, even in California, we have big distinctions between Southern California and Northern California. I'm in Southern California, mostly in Newport Beach. I have one of my best friends is a realtor up in San Jose. And he and I talk all the time about how remarkable it is that there's just big differences in not only the sale process, but then in the escrow process. So for example, in Northern California, at least from his point of view, they don't really use traditional escrow companies. They just use a title company that sort of facilitates both the title and the escrow. Whereas down here in Southern California, we tend to have a title company and an escrow company, and usually they're different providers. So, go figure.
I know. Everybody wants to be a specialist.
Yeah.
So I know that you have some thoughts to share with us about Proposition 19 and sibling buyouts, and how families can use bridge loans to facilitate, transfers and stuff while trying to keep in play the property tax basis of Prop 19.
Yeah, absolutely. I mean, we do so much Prop 19 work. It's kind of near and dear to my heart. I'm not a fan of Prop 19. I think it was they pulled a fast one. And really did a big disservice to a lot of people. It basically ends up being a death tax. But to be quite honest, I mean,
just for us, what exactly is Prop 19?
Yeah. So basically, back in the day, we all kind of remember, you picture that Howard Jarvis taxpayer tax revolt. They brought about Prop 13. So most people are familiar with Prop 13. That's basically the proposition that was in 1978, where if you buy your property and whatever you buy it for, technically the fair market value, but usually it's basically what you buy it for, the state can only increase your taxes 2% per year. And that's enormous, right? So that's why you have people that bought their houses back in the 60s, 70s, and 80s. They're paying like $1,000 a year in property taxes, even though their house might be worth $1 million, $2 million, whatever it is. Some people think it's unfair. Some people think, well, it's basically just a tax on unrealized gains, right? Just because your property has increased in value, should you really pay taxes on it? So that's what Prop 13 did, right? It keeps that nice low basis that can only go up a little bit. So along the way, the voters initiated another proposition, 58, and then later 193, which basically said, well, you know what? We'll let you pass that on to your children. So let's say you bought that house in the fees, you've got that nice low property tax basis, you die, you leave it to your children. Well, the old rule was essentially that your children could then just inherit the property tax basis. So their property taxes would stay at that nice low amount that the parents were paying. And that was the rule for many, 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 many years. Prop 19, which came about 4 years ago, or has been implemented for the last 4 years, really did a big number on that. And it basically, for a lot of purchases, took away that ability to transfer the tax to your children. So in a lot of circumstances nowadays, if the parent dies and leaves the property to the child, their property taxes are potentially going to go up, and potentially going to go up significantly. I mean, you could have a house that's worth $1, $2, $3, $4 million. Property taxes are 1% per year. So you inherit a $4 million house. You might be a school teacher or a firefighter or someone who's not rich, but you've inherited a very expensive piece of property. Now, because of Prop 19, you're going to get readjusted to the fair market value, 1% of the value, $4 million. That's $40,000 a year. So we've had people that are like, oh my gosh, I'm a school teacher. I inherited my parents' property in Newport Beach. It's a great neighborhood. I wanted to raise my children here, but I can't pay a $40,000 a year property tax bill. So they're having to sell the home, which unfortunately was sort of the desired intent behind that proposition. There is an exception. There are some limitations where on the family home, you basically get up to $1 million in value now. So if you inherit $1 million house and you move into it, and there's certain rules you have to follow that we talk about, or you can find it on county websites, our websites, things like that. But basically, if you move into the house and it's $1 million or less, your taxes won't go up. But once you start getting into properties that are
Interesting.
valued at over more than $1 million, they're going to go up. And
Will they go up by the full amount or only up minus a million?
exactly, minus the million.
It
So
is minus the million.
it
So
is
if it,
minus the million. Yeah.
so if it's
So,
a $2 million property, they'll only be taxed on 1 million
well, yes, with an asterisk.
based,
So
based
there's
on
kind
what
of
they're
a,
currently paying.
yeah. There's kind of a complicated formula. Basically,
Okay.
it phases out. They've adjusted twice for inflation now. It's 1,044,000 is something like the number now. So if the house is $5 million, right, a good way to think of it is, well, okay, so you would be now paying $50,000 in property taxes per year, but you get to deduct that 1,044,000. So now you're only paying $40,000 a year. So you get $1 million off once you
Right.
kind of get to a certain point is a good way to think of it. So if you inherit that $2 million house, your property taxes are, depending on what the parents were currently paying in their basis, it might not go up that much, but it might go up $3, $4, $5, $6,000 a year. And, for some people that could be a significant amount.
Sure.
So yeah, talk forever on Prop 19. For a lot of people, it ends up increasing your property taxes. But there are some people, certainly if you have that house that's under $1 million, or again, depending on your parents' initial purchase price, there are some people that fit nicely within the new criteria. They're going to move into the home. It was the family home. You got to move in within a year, and you're going to be able to get that nice low property tax basis. For people that are inheriting larger estates, for the majority, they're kind of out of luck, or your benefit is going to be that small amount of savings.
And then there is a note on gifting of equity to a family member. So you wouldn't necessarily inherit, let's say, while your parents are still alive, they put you on title. How does that work? How does gifting of equity work as far as tax implications and things like that?
Well, this is a great one, and this is where the mortgages definitely come in. So we do a lot of these. So sometimes people say, okay, well, I don't want to wait till I die to give my property to my children. Maybe they want to either gift it to them now, or sell it to the children now, or sell it to them for below fair market value, which is basically a hybrid of the two, right? So let's say, for example, you have a house, a parent owns a nice house, and it's worth $3 million, but you're saying, hey, I want to give the kids a break. I want them to raise the grandkids here. I want them to enjoy this house. I'll sell it to them for $1 million. Well, you can do that. Absolutely. A lot of people think, oh, you can't do that. Well, of course you can. But that difference between the $1 million purchase price and the $3 million fair market value, that $2 million difference is now a gift. So the parent then needs to simply report the fact that they're giving a gift of $2 million. With the current estate tax allowances, you can give $13.99 million tax free. And in some of the current legislation, that may actually even be increased a little bit. So for most people in most estates, you can either gift the property to your child, essentially tax free, or you can come up with these hybrid proposals where you sort of sell it to them below fair market value. And then we have people definitely get loans involved to do that. Because
Sure.
even if you're going to buy the house for $1 million, yeah, you're getting a deal, but most kids still don't have $1 million lying around. So very frequently then people are, getting a traditional loan, but, now I don't need a $3 million loan. I only need $1 million loan. So it's really making it a lot easier for that
Right.
next generation to potentially get the property.
And then would the tax, because you are purchasing and not refinancing, would the tax rate then change as well based on $1 million, which is the purchase price, or $3 million?
So unfortunately, the pesky Prop 19 then comes rearing its head again. And so if you sell the property to the child for $1 million, a lot of people think, oh, great, I'm going to basically pull a fast one on the county. They're going to reassess it at the $1 million, or maybe not reassess it, depending on what the parent's rate was. Unfortunately, that is not the case. So even when you do the gifting, the county has the ability, or really it's just the law, is that they can tax you on the fair market value at the change of ownership. So even though you're going to report that $1 million sale, and they're going to see it, the county is going to see that paperwork effectively that indicates it was $1 million sale. If their little computer says, well, wait a minute, we think this house is worth $3 million. Unfortunately, they're going to figure that out, and they're going to send you a bill based on the $3 million bill and not the $1 million bill.
And what if the parents don't, what if they don't sell it to the kids? What if they just add the kids to title?
Yes. So that's a great workaround. And there's a lot of reasons that, we can go in really in depth, or we've got some articles, but there's a lot of reasons why you might not want to gift the property to the child while you're alive. One of the biggest ones is because of that Prop 19, the property taxes might go
Yeah.
up. Again, if you qualify for the Prop 19, maybe it's not that bad. Maybe you want to do it anyway, because again, you want to move in, start raising the grandkids there, whatever. But for a lot of people, tax-wise, it's usually not advantageous to gift the property now. It's usually better to wait until you pass. And then if you pass away, well, you're sort of kicking the can down the road to that proverbial tax increase with the property taxes. So you can add a child on as, for example, a joint tenant, and that's
Right.
not going to add to the property taxes. It's not going to increase the property taxes then. But as soon as the parent passes away, now it's fully transferring to the child. Now the child's going to get that property tax increase.
They will when the parent, even though they have ownership in the property.
Correct. Yeah. Yeah. So that's sort of a misconception. There's a lot of people out there think, oh, I can circumvent Prop 19 by adding my kid onto title. Or, oh, I'll put it in a trust and that circumvents it. No, none of those things work. The county's going to figure it out eventually, probably. I mean, I'm sure there's people out there pulling a fast one, just like there's people that cheat on your taxes, but
Right.
obviously you're not supposed to do that. So, when you inform the county, or certainly the jig is up if you go to sell it, right? Because then you've got to file with the county that affidavit of death or a change of trustee. You've got to change the title with the county. And at that point, they're certainly going to know. And, if your parents died 5 years ago and you never told the county about it, you could be looking at an enormous back due tax bill.
And can you be really tricky? These are just all thoughts that are happening in my head. Could you put the kids on title and they're done with this big house? They don't want the big house. The kids want the big house. They put the kids on title. They keep all 4 names on for whatever, a year. And then the kids do a loan, which they certainly can because they own half the property legally. So I can give them a loan as a refinance. You just have to wait 6 months. You have to be on title 6 months, and then I can give them a cash out refi. And it's considered a refi, so taxes don't get reset. They get 500 grand to give to the parents because the parents want to go buy in Palm Springs. And they're like, we're done with keeping this big house. You have children, you keep it. We're going to go live in Palm Springs. Just give us 500 grand so we can go buy that.
Yeah.
And the parents take themselves off title.
It's so yeah, you can do whatever you want. And we do get people that do that. But the second the parents come off title, now you're getting that reassessment.
So the county will get triggered when the parents come off title.
Absolutely, yeah, because you're going to file that with the county that's, now removing parents and it's just leaving the children. And at that point, they're going to figure it out and they're going to say, okay, we're going to reassess you at that point. But it is a good way to kick the can down the road, right? Because again, if you just gift or sell the home to the children today, that reassessment is going to be today. Whereas maybe you do buy some time by that sort of hybrid scenario, add the kids on as joint tenants. Maybe that helps with then getting the loan, because now instead of getting a purchase loan, now we're doing some sort of cash out refinance. Maybe you can get a better rate on that. Maybe it's easier, or whatever advantage that might bring to the children and the parents.
Just taxes.
So you kick the can down the road for any number of years, and then the parents ultimately decide, okay, now we'll give you the house. So you're basically just delaying the inevitable. But if that Prop 19 property tax increase to the effect of $10,000, $15,000 a year, yeah, let's kick that can down the road for 5 more years.
Right.
Because now we've just saved $50,000 or more by essentially delaying the transfer.
Right.
So, you're almost always better off delaying it. The only times that we see people do it is because there is that real motivating personal need to, I want to own the house, right? I want to start building equity as the children, right? I want to start owning it. We want to raise our kids here. We want it to be ours. We don't want to be worried that the parents are going to change their mind when they get older and decide to leave their half to charity or, something like that could happen. So, typically doing the joint tenancy and kicking the can down the road is it can work. But then I'm always kind of like, well, why? Unless you need the money. Sometimes people do that for refinancing purposes a lot, where, you need the children on title to do the refinance because maybe the parents can't qualify for a refinance on their own. So we definitely see that a lot.
Right. Interesting. And would the gift of equity come into play then, or does it matter?
Oh, yeah. Let's start with the gift of equity. So the gift of equity is where if the children are actually going to buy it outright from the parent. So let's say nice clean example, you've got a $2 million house. The parents are going to sell it to the children for $1 million. So they're gifting $1 million. But the child now still needs to come up with $1 million to buy out the parent. So the child's going to go to a lender and say, hey, I'm buying my house from my parents. Great. I need $1 million loan. They say, great, we'll give you $1 million loan. Typically, as you know, with a loan, you need some sort of down payment, right? You're going to require 20%, whatever the down payment is. Well, basically now, in a fun way, we can do it so the children don't have to put any money down, because this equity, this $1 million that the parents are gifting, the lender's going to factor that in and say, hey, look, I know the property's worth $2 million. Therefore, I'll happily give you $1 million loan, because essentially it's only a 50% loan to value ratio now, right? So assuming they can qualify for the $1 million loan.
Then you're purchasing at that max amount.
Yes.
I just closed a loan as gift of equity.
So let's talk about this, because I've had arguments with CPAs over this. So you're exactly right, Natalie. You just honed in on the problem then that happens with the lender a lot. So the lender says, sure, I'll absolutely give you $1 million loan for a $2 million house. But the problem is you can't come to me with $1 million purchase and get $1 million loan. Right? I'm not, as a lender, going to lend you 100%, even though I know the property's worth more.
Right. It still has to value and be the purchase. We always take the lesser of the two.
Right.
Value or purchase contract.
Yeah. So let's take this example to the extreme. So let's say we say, okay, let's just put a $2 million purchase price on the contract. Now the lender, the underwriting, they're going to be happy as a clam, right? We've got a $2 million purchase, only need $1 million loan. Great. Assuming you got the income, credit, all the other good things, the lender's going to give you that. Now the parent is in the situation where, wait a minute, I've only actually gotten $1 million out of this transaction, but now I'm getting 1099 for $2 million. What do I do? Well, the answer to me is very simple. You report the $1 million sale. You don't report the sale at $2 million, because now you're asking for an extra $1 million gain that you're potentially going to owe capital gains on. So the IRS rule isn't what did the escrow company 1099 you on? The IRS rule is what was the amount realized in the transaction. So you simply report to the IRS, I only realized $1 million sale. And by the way, I've got an escrow settlement statement, if I were to ever get audited, that's going to prove that. Because right on the escrow settlement statement, it's going to say purchase price $2 million, gift of equity $1 million, loan $1 million, and you're going to have some other expenses and all this other stuff. And it's going to then show right there how much the parents actually netted. So,
and it's only but wouldn't it still need to be considered for tax reasons a gift of $1 million?
Yes. Yeah. So that's sort of the next piece of paper that helps you out, right? So now I've got this escrow settlement statement that shows the $1 million gift of equity. I'm also reporting that $1 million gift, right? So I'm going to do a form 709. I'm going to report, hi, Mr. IRS, I have gifted my child $1 million by virtue of this gift of equity. So now I've got the tax form that shows that I gifted it. I've got the escrow settlement statement that shows that I gifted it and I only received $1 million. So now I absolutely just report on my taxes that the purchase price was $1 million. And yeah, now there's an annoying disconnect because there's a 1099 floating around out there that says I got a $2 million. But if you were to get audited, you're not cheating taxes. You're being 100% truthful in the amount realized, and you have the documentation to prove it.
Who sends a 1099?
The escrow company.
Do they really?
Yes. Yeah. At the purchase price. Yeah. So they don't care what the loan was, what the realtor fees were, none of that. They are legally obligated to 1099.
They're legally obligated. They send a 1099.
Correct. And that's one of the forms that you'll fill out as part of the escrow process. There's a 1099 worksheet where they say, what's your social or your EIN, maybe if you have a trust or an LLC. And they're absolutely sending you a 1099, and then they're sending the IRS a 1099.
Yeah. I remember a ton of that during short sale season in 2008, like when everybody was short selling or foreclosing, and they thought they could get rid of the house without worrying about the fact that they are going to be 1099.
Yeah, there's always a paper trail.
Because it's a recourse loan, right? So they forgot that, like, we bought this for 700,000. We got a loan for 700,000. We short sold it for 500,000. and they get a 1099 for 200 grand.
Yeah.
Because that's kind of the money they earned based on the lender only getting 500 of their 7.
Yeah, I
Interesting.
know. Yeah, it is. There's always that pesky paper trail, right? But when it comes to gift of equity, you have the paper trail to prove that that's not the case. And I literally had multiple clients where their CPAs, I had someone come to me even after the fact, their CPA reported that higher number, the 2 million in our
Oh,
hypothetical.
goodness.
They paid hundreds of thousands of dollars in capital gains taxes, literally like 250 grand or something in capital gains taxes. And he's like, no, that doesn't seem right. And you must have found one of my articles online or something. And we do a consultation. I'm looking at it. I'm like, yeah, why on earth would you have reported that and paid those taxes? And he's like having this fight with his CPA, and then I get involved and we start writing some letters. And I think I told him, you need to get a new CPA and you need to amend that return and get back that $250,000 because he didn't get the money. But the CPA was just like so fixated on the 1099 and even looking at the settlement statement at that purchase price. But everyone was completely ignoring the big giant line item that said gift of equity.
Gift. And so that's interesting because didn't you say, even though the reason that you can ignore it is because it's a gift and you're allowed to gift up to around 13 million.
Yeah, 13.99 this year.
In a lifetime. Is that what it is?
Yeah, it's a lifetime allowance. So you report that $1 million gift, it gets
taken
a record
off.
of it. That's why you have to report it, right? So it's keeping track of it. So if you'd later die and you've got a $20 million estate, well, that million's going to come back and be factored in.
And what's the yearly gift amount? I remember last year it was like 17,000 or something per child.
Yeah, so it's 19,000 this year. And that's another 19,000. That's another topic we do a lot. People are confused by that. What's the difference between that lifetime exemption and the allowance amount?
Right.
And it comes to a reporting requirement, right? So basically 19,000 is the amount this year. So the IRS is basically of the opinion that you give someone $19,000, I don't even want to hear about it. Don't even bother me with that. And that's really powerful.
They won't report it as part of the 13.
Exactly. You don't report it.
Got it.
And that's really powerful because it's also per person per giftee. So you can have dad gifts daughter 19,000, mom gifts daughter 19,000, dad gives son 19,000, mom gives son 19,000. All of a sudden we've transferred, almost $80,000 per year. So a lot of higher wealth people, or even not necessarily wealthy, but you may have a couple $1 million and you can essentially use that to then reduce your estate. So if you're concerned about having some sort of estate tax bill when you die, you can sort of start chipping away at it now by giving it away now.
And we do that all the time for gifts in escrow. So like the parents don't want to worry about taxes on gift, and which is kind of an interesting thing. I don't feel like you ever have to, but a lot of the times I'll be like, well, you have 3 children and it's you and your husband. And last year, whenever it was like 17, and I was like, each of them can get a $17,000 gift and you don't have to worry about that.
Yeah. Yeah, it's really powerful. But it's funny what you said is right. So many people now, I mean, these numbers, 13.99 million per person. So for a married couple, that's 27 million or whatever the math is. What's the math? That's not my strong point when I have to add things together. 14 each, right? So almost 28 million.
Yeah.
I mean, that's enormous. Obviously, there's estates in our market that exceed, there's houses that exceed that, right? So it happens. But for the vast, vast, vast majority of people that own a, house that's maybe worth $1 million, $2 million, maybe they've got some savings, they've got, whatever you've got, there's just an enormous amount of the population now that is under that amount.
I know it's almost like, why would we worry at all about the gift amount? Because a lot of parents want to gift their child $500,000 towards the purchase of a property. And a lot of the time they get advised from their accountant, well, you can't gift $500,000 or you're going to be taxed. But hearing this from you was like, what are you talking about? If you've got up to 14 million lifetime of gifts, then no, you won't be taxed, right? That's so funny that so many people come back to me with this issue that isn't an issue.
They still do. It's the same thing with the gift of equity. I mean, I get like one of my biggest Google searches is, can I sell my house to my child for $1? And obviously no one's gonna sell it for $1. It doesn't make sense, but there's still so much confusion on how those gifts work, because I think there's this perception that, I'm cheating taxes by gifting away, whether it's giving them $500,000 for a down payment or selling the house below market value, that we're somehow doing something wrong. But as long as you report that, you're not doing anything wrong. And with those $0.9 million allowances, there's no reason not to. Now those numbers weren't always the same, right? In fact, if Congress doesn't act, the current law expires this year. So it's going to go back down to like, I think it's still like 5 or 6 million. I forget what the number is, to be
I
honest.
think it is 5. Yeah.
So, that's a game changer because
Child not have to pay taxes either. They just get the house and that's it.
as long as it's under those allowances, right? So
Right.
yeah, so if you inherit a $5 million house and that's the bulk of the parent's estate, you're done, right? There's no taxes due on that whatsoever. But you inherit a $30 million house and now you've got a problem.
It's both you and your husband, right? Because then you each get 14.
Well, right. So we got 28 million, right? But I assume
Yeah.
if you're inheriting a $30 million house, there's probably some other things that are coming along with that $30 million house, right? There's probably some cash, some
Furniture.
savings, some gold bars lying around, whatever else it is. But yeah, I mean that estate tax allowance, it certainly impacts less and less people. And I know the current proposal is even adjusting it up to 15 million. So, the likelihood of a lot of people that are getting mortgages to buy houses, the fact is this doesn't matter to you. And even right now in that hypothetical where the parents are gifting the 500, do it now because that's the law today. Let's say all of a sudden the tides really change. You get a
Right.
wildly different administration and politics, 5-10 years from now. Let's say they set the number at 0, right? Because there's plenty of people out there that believe estate tax should be essentially 100% of anything, right? So let's say there's no estate tax allowance. Well, they can't come back and say, "Oh, you gifted 500,000 way back when, now you owe me taxes on that." I mean, I guess nothing would surprise me, but in theory, that's not the way tax law changes work. So, we know what the laws are now. So that's why people are acting now. And that's why some people are doing these gifts now because they know, hey, I can gift up to that 14 million. Let's give the kids the house now. Let's sell it to them below market value now.
Right.
Because usually you're not going to have any sort of estate tax on that. But going back to that pesky Prop 19, the kids' property taxes might increase. And depending on what you sell it for, you still have capital gains to be wary of, right? So even if you sell that house to the kids for $1 million below market value, but if you bought it for 50 grand back in 1970, you as the parent still might have capital gains. And so sometimes we have people really kind of play with those numbers too to make sure there's going to be no taxes, right? No inheritance tax, no capital gains, and certainly try to avoid that Prop 19 if you can. But that's usually the one that's usually the biggest problem for most people.
So interesting. Thank you so much. Is there anything else? This was wildly informational. I learned so much. Anything else that you feel like we should know or that we missed or that's important?
Oh gosh, I don't know. These topics are so nuanced. So, sometimes we talk for like an hour at a time just about some of these things. So, all I can say is, the lawyer in me says, disclaimer, don't go, making giant tax considerations based on a 45-minute podcast or whatever. Obviously consult with your tax advisor, reach out to your CPAs. It is a service we provide. There's a lot of articles out there. Be careful what you read on the internet. I mean, when I see people come to me, they're like, "Oh, I saw on a Reddit post it said I can do this." I'm like, no. Okay. But look for articles from reputable attorneys, reputable mortgage brokers, things like that. And then you do have to kind of verify because just like, look, there's couple 100,000 lawyers in California and we have courthouses because people can legitimately disagree on something. So, I've had plenty of people come to me that, like the CPA example where, hey, my CPA says this. I'm like, they're wrong. So,
Right.
sometimes if you're talking about very significant things, sometimes you might want to talk to more than one tax professional.
Right.
Just like you'd interview multiple realtors perhaps to sell your house. Sometimes if someone's telling you, oh yeah, you're going to owe $1 million in capital gains, I might want to double check that.
Totally.
So, because some of these things are complicated. And Prop 19, I mean, it's been around for 4 years now, but it upended law that was law for 40 years. So, there's still people to this day that, hey, mom died a month ago. What's this I hear about Prop 19? And they have no idea. Because for a lot of people, unless you're dealing with inheritance or death, Prop 19 doesn't impact you.
Right.
So, it's still a topic that is, I don't want to necessarily say evolving, but I'd say there's still a lot of misunderstanding and people that are just outright wrong, especially if you're just searching the internet.
Yeah. Well, props on a whole are very confusing to really understand. What do they what gets implemented when they come into play and what does it really mean for us and how does it really change our laws? And it's a hard thing to understand and know when they are passed.
Oh, it's great. And propositions, I mean, it's so preposterous because it's just, it's special interest buying laws. And, you see the TV commercials and like Prop 19, for example, the TV commercial was, oh, we're going to give money to wildfire victims or something like that. But actually, it was the Realtor Association that funded the vast majority of Prop 19. And the whole reason is because, hey, I'm going to generate more home sales, so
you can get more home sales for sure. Well, of course, because it's, people are less inclined to want to take on that kind of tax liability. But yes, I think the props are an interesting, wildly swayed type of law passing that we get to do as citizens without even understanding them. I throw a proposition party every time we have to vote.
It is unusual. Not every state allows it. Because I mean, it's kind of that true direct democracy that some people think is a great idea, and it has its purpose, right? So you're circumventing the legislature. But at the end of the day, the reality is, well, it's who's got the money,
90%
right?
of people don't have any idea what they're voting for when they vote.
I mean, you don't, because you're watching some TV commercial that's, 10, 20, 30-second TV commercial. No one's reading that voter pamphlet that's saying what the law is. And even that can be misleading because...
And even that's confusing, exactly. And there are also sometimes so many, you get confused what is what. But yeah, I do like pamphlets and all of my friends get together. We each get a prop that we have to explain. You're not allowed to tell me your opinion. You're only allowed to say what is yes, what is no, and who funded it.
Nice.
So that's always like the most important thing is like, who's funding it and why did they fund it?
That's so true. Yeah, you got to peel back that onion because in a lot of times you can't even find that in the ballot thing. It says who's supporting it, but it doesn't necessarily tell you where's the money coming from.
Right.
And sometimes
once you find that out, it is incredible. It's like, what? The paramedics are funding this? Like you find out all these like weird things that you're like, or the realtors are funding this and giving the wildfire.
I mean, you look at Prop 19 and there's not the word realtors mentioned, nowhere in anything. It's all about wildfire victims and this coalition to support whatever. I mean, it's like nine. I forget what the exact. It was like million. I mean, they gave over 40 something million dollars to that proposition, and the next runner up was some like firefighter union that gave like $100,000 or something. So I mean, it was just preposterously disproportional how much that was funded by the Realtor Association, and it's still barely.
I wonder if that's working out for them, like.
Yeah, I mean, I get it. And I get the politics and the optics behind it because a lot of people are like, oh, boo-hoo, you inherited some $5 million house, now you have to sell. And I get why people, don't get the most amount of sympathy. I get it. And I get that it's an easy target. Oh, you inherited a $5 million house, you're rich or whatever. But again, maybe the $5 million house isn't a great example. Let's use the million.
That's a harder one. But even just like $1.5 million, people can't afford 15,000 in
That's
tax.
it. And it's like, just because, we live in $1 million or $2 million house, it doesn't mean you're rich. It means, you or your parents bought it a long time ago.
And also it's probably in LA or in these markets in California, it's just a very standard basic house.
Yeah. And people are hot to say like, oh, they should pay more. And I'm like, well, I mean, it's basically the same thing as taxing unrealized gains, right? So, in your retirement account or your stock portfolio, we're not taxed on unrealized gains in this country. But we are when it comes to real estate. But I mean, imagine, if the average retiree was all of a sudden now having to pay taxes on their stock portfolio. It's like, well, wait a minute, that doesn't make sense. So anyway, it's, I guess I understand, why some people certainly are against Prop 13 and in favor of Prop 19 and that sort of thing. But, the reality is that, we see regular, ordinary people that are forced to sell their homes because they can't afford to live in it. And by the way, if let's take the rental property, for example. Like, this is actually my favorite thing, maybe one of the last things we'll talk about. So let's say I inherit that duplex or quadplex rental, and now my property taxes are going up from $5,000 a year that mom used to pay to $50,000 a year. Guess who's ultimately going to be paying that property tax?
I didn't even think about on a rental property.
I'm going to be increasing the rents, and I know we've got rent control. Yeah, but you can, right? You can still up to a certain amount. So maybe now
3% a year.
Yeah, but there's loopholes to that too. Bottom line is that at some point in time, the rent, if I as a property owner now have a $50,000 property tax bill where I used to have a $5,000 property tax bill, I'm not eating that $45,000 a year, right? It's like all this tariff talk, right? Like who's ultimately paying, let's be honest, like ultimately it's going to trickle down to the tenant in these situations where, maybe it's only a 5% increase this year, 7% this year, 10% next year, but maybe I would have raised it 0 if my property tax bill was 5,000. But now I've got a $45,000 shortfall. So I'm going to slowly but surely start raising your rent. And that's just the reality. So it's increasing the cost and it's just going to the state and getting into a whole other conversation then.
Yeah, exactly. Now we're getting political. I'm kidding. Well, anyway, it was such a pleasure, Devin. Thank you so much for joining us and sharing such incredible information for my listeners and everyone out there. This was, wildly informative and
well, thank you for having me. Yeah, I know it's a lot of information and,
good. I have honestly so much more. So many things came into my head while you were talking that I was like, I'm going to hold because it's too much. But yes, thank you. Maybe you'll join us again sometime.
Excellent. Well, I'd love to. Well, thank you so much for having me.
Oh my gosh, my pleasure. Thank you.
Thanks for listening to Mortgage on My Mind. If you're ready to start your mortgage journey or have any questions, I'd love to help. With 20 years of experience, I make the process as simple and stress-free as possible. Check the show notes for my contact info and don't forget to subscribe, leave a review, and share this podcast. Until next time, I'm Natalie Salins, here to help make your real estate dreams a reality.